Most financial advisors tell you to diversify your portfolio. But then you have some people, billionaires, say like Mark Cuban, who says that diversification is for idiots.
All that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
So who's right? I'm James Furlo, teaching real estate investors strategies and tools to maximize their long-term cash flow while minimizing headaches. Thanks for watching. So I was recently listening to this really interesting podcast about this guy who helps billionaires invest. And he had a really interesting framework, which I think kind of solves this conundrum. Do you diversify or do you focus? And shockingly, the answer is both, of course. The way he thinks about it is in terms of 3 distinct buckets. And in each bucket is where you get your diversification. But then within each bucket, you may or may not diversify at all. The first bucket, that's your defensive portion. The goal isn't necessarily to make money, but the goal is to not lose money. And that is where classic diversification works. The goal is to own a bunch of separate companies that have nothing to do with each other and get the returns from there. Again, the returns aren't going to be amazing. You're not going to necessarily earn a ton of money, but ideally, over the long haul, you also won't lose money. So this is where classic things like the stock market and bond market and buying some international stocks and maybe some REITs and some other things like that, that would play into the defensive bucket. Unfortunately, this is where most people stop, right? They have the 60-40% split rule where 60% of it's in stocks, 40% of it in bonds, and then they stop there. The problem with that is that you're leaving a lot of money on the table because you're over diversified. You also need to combine that with some focus. So the second bucket is cash flowing real estate. And it's exactly what it sounds like. It's buying ideally bigger commercial real estate passively so that it's not your main focus. It's still just an investment strategy. But this is real estate that is primarily giving you cash in form of distributions every once in a while, and also has the potential for value to go up. Now, chances are you're going to make a whole lot more than what was in the stock market. You're also not going to be nearly as diversified depending on how much funds you have, because usually to get into a syndication costs around $50,000 to get started. So you might be involved in 1, 2, a few dozen, again, depends on how much wealth you have. But the idea here is that you're not the one who's in control. It's being passive. It's not your main focus. The third bucket are direct investments. Think of this as like owning a business or having a job. This is where your time and attention goes. This is where you do not diversify at all. And this is what Mark Cuban is talking about when he says diversification is for idiots. Instead, you focus on this one area and you become an expert at it. You get good at it. You hone your craft, whatever that is. And that is how you generate disproportional amount of value and wealth from doing whatever that thing is. So I was looking up some examples, and here, let me just read them off to you. So Jeff Bezos, he started up a company, Amazon. I think you remember that one. Same with Bill Gates. He started Microsoft, and that is where they focused. Elon Musk, today known for Tesla, SpaceX, well, and Twitter, I suppose, but that's not actually how he got started. It says here that he started with a company called Zip2, which was then bought by Compaq. And then what he did was he focused on a company called X.com, which eventually got merged into PayPal, which then was eventually bought by eBay. And that's how he actually got started. So it really was by focusing, and it's only now later in life that he has expanded what he's focused on. I find this next one super fascinating. It's Kim Kardashian. She started with a small retail business called Dash. And the whole goal of her reality TV program was to help her sell more of her products. Now, obviously, that went in a completely different direction, and good for her for realizing that and then focusing on her own personal brand. But those are all examples of billionaires who focused solely on their business. And I get it. There are a lot of examples of other people who aren't billionaires who also tried to focus and it didn't work out for them. But the point is, you have these 3 different buckets where some of it is in this defensive play. You're not touching it all. You have zero interactivity with it, just like stocks or bonds. The next bucket is that cash flowing real estate. You have a little bit more involvement, but for the most part, you are a passive investor, and that is providing you some cash flow and value. And then that last bucket are the direct investments, and that's where you're focusing your time and attention. And it might be a business, and it might also just be your job getting really good at it and going for promotions and getting raises. So this starts to beg the question, okay, what percentage and how big of the buckets should I have here for this, let's not call it diversification, even though that's exactly what it is. I don't know exactly for your situation what you need to do, but I can give you some data which can point you in the right direction. Check out this chart from Edward Wolf. He researched where people of different wealth levels kept their money. So what we're looking at here is the percent of gross assets. You have your middle income, upper, and ultra rich. And one of the very first things you're going to notice is that the middle income, which we define as having a net worth of 0 to 40, almost 5K, is that primarily their wealth is in their principal residence. And this is not true at all for the ultra rich or even the upper income. They primarily have their wealth in the stock market and in business equity or other real estate. And so you can kind of see with the ultra rich where those three buckets are playing. They clearly have wealth in a business and in real estate and in the stock market, and then they have just their regular living piece as well. And I get it, their percentage for their home is going to be smaller because, well, they're worth over $10 million. You can have a nice house, but you can't have that nice of a house. I get it. But the point is, for your investments, you don't just want to be 60-40 stocks and bonds. You want to take some of that and you want to invest it in other areas. And some of it might be your job. That's really where you're focused on, getting good at that. And that's totally okay. And what that means is that chances are you're missing that middle bucket there, the cash flowing real estate, to help bridge the gap between the two of them. And that is where passive investing plays really, really well. As I'm going to tell you a dirty little secret here. All active investors like myself always could use more cash. And so that provides an opportunity for you to go in, provide the cash to help with this investment, and everybody gets a good return from it. If you're interested in doing something like that, we'd love to chat. Visit us on our website and set up a 30-minute call. Let's talk about where your portfolio is, where your buckets are, what your goals are for the future, and maybe it makes sense for us to partner with you. If you found this helpful, please like this video. And if you'd like to get more tools and tips for maximizing your cash flow while minimizing headaches, please subscribe. Thanks for watching.